Nathan Alim, the real estate boy, and welcome to part two of the home buyers playbook. Now, in this stage, what we're going to talk about is getting ready. We're going to be laying the foundation for home buyers. All right. So let's jump right into it. So again, this is laying, we're going to lay in this episode, we're going to lay a strong foundation in preparing you guys to be homeowners. So let me turn my mic around here a little bit so you guys can hear me. All right. So this is pregame. All right. If you played sports in the past, this is pre right now for us to buy a home. Now, during this laying the foundation phase and getting started, in this episode we're going to teach you five things. All right. Number one, you're going to know how much home you can afford. Let me bring my screen in here. I keep getting this every time. All right. uh Give me 1 second. Let me bring this screen in here for you guys. Okay, there we go. So in this episode, we're going to go over five things. Number one is know how much home you can afford. That's the first thing. Number two is understand the cost of buying. Number three is understand the cost of home ownership. And number four is understand the role and your credit score. And number five is understand the benefits of home ownership. So that's what we're going to take care of in this model. Let me hide this real fast. All right, let's go on up. All right, my changed this slide, which is kind of killing me right now. First, know how much home you can afford. Right now, talk about how much home you can afford. So, affordability. You're probably wondering how much home you can afford with your income. So figuring out how much home you can afford is not rocket science, all right? There will be other factors to consider, but starting off is simple calculation that will do. All right, so we're going to do simple calculation and find out how much home you can. So mortgage lenders qualification ratios to determine how much they will lend. So, although each lender uses slightly different ratios, most are within the same range. So, in lending, here's the golden rule. All right, here's the golden rule. Your monthly mortgage payment should not exceed 28% of your gross monthly income. So that's your income before taxes taken out. Again, I'll say this golden rule one more time is that your monthly mortgage income should not exceed 28% of your gross monthly income. Okay. What's your gross monthly income? That's your income before taxes are taken out. So let's look a closer look at this. We have the 28% rule. As all right, total housing costs should be no more than 28% of your gross income. Housing costs in the 28% rule refers to PITI. What's PITI? You have your principal mortgage payment, your interest, your property tax, and your homeowner's insurance. All right, that's PITI. The 28% rule, also known as the front end ratio, measures borrowers' ability to afford their mortgages based on their household gross monthly income and monthly housing related payments. So if you're out there, now one way to do this is that you could just go get pre-approved. Okay, you can go get pre-approved, but when you go get pre-approved, they do run your credit. So if you're trying to find out, okay, how much home can I afford, then you can use this 28% rule. All right, hold on 1 second. All right, so again, the rule of thumb, well, no, it's going to show you next exactly what it is. So it's pretty simple. Pretty simple. For the It means for every dollar you or your partner have in income, you're spending 28 cents on your mortgage. That's it, 28 cents, not a cent more. So the 28% rule is only one way mortgage lenders look at your ability to afford mortgage payment. All right. So that's because there's a lot of banks out there, there's a lot of mortgage companies out there. So they all don't use one rule. Okay. The 28% rule is one rule. All right. There's also the 36% rule. All right. This rule stipulates that your total housing payments, including mortgage, homeowners insurance, private mortgage insurance, association fees, and property taxes, should not exceed 36% of your gross monthly income. And again, this gross monthly income, what do you mean? You got gross monthly income and you have net monthly income. The gross monthly income is your income before taxes are taken out. Okay. So look at that. How do we figure the 28%? You have your gross monthly income, you times that by 0.28, and that's going to equal your estimated max monthly housing cost. All right. So that's how the 28% rule works. Now, the 28% rule is only one way that mortgage lenders look at your ability to afford mortgage payments. So we already spoke about that, okay? And again, there's also the 38% rule. And this rule stipulates that your total housing payments, I think I went backwards. I think I said this already, okay? Let me move forward. And we talked the 36% rule. Okay. So here's the 36%. Some mortgage companies do the 28% rule, and some do the 36% rule. So what's the 36% rule? The 36% rule is your monthly gross income times 0.36. Okay, that's going to equal your estimated max monthly housing costs. So one more rule to consider. Okay, there's one more ratio to consider, and it's the rule that says your total housing costs and all other debt. Now, with the 28% rule and the 36% rule, it was just your monthly income. It was just your monthly income. But with the 40% rule, what it is your total housing costs and all other debts should be no more than 40% of your monthly gross income. So this rule means that if you have a big car payment or a lot of credit card debt, you won't be able to afford as much in mortgage payments, or you'll want to pay those debts down. All right? Let's move to the next slide. And this is the formula. 40%. Remember, you got the 28% rule, you got the 36% rule. Both of those deal with your monthly cost, your monthly income. But this 40% rule, it deals with your monthly income, but it also deals with the other debt that you have. All right. And it's the monthly gross income times 0.40. Okay. So let's keep. All right. So some lenders will a borrower with a slightly higher or lower ratio. It all depends on the lender, the mortgage type, your credit history, and other individual factors. So what this means right here is that it's not just hard and fast, okay, if you don't have this ratio, that's it. Okay. There's a lot of moving parts when you're dealing with a mortgage. That's why one of the best ways just to get pre-approved, and see exactly what you could qualify for. Okay, because some of these are moving targets. It says down here, for example, in 2019, the front end ratio is 31%, and the back end is 43% for a FHA loan. And energy efficient homes could qualify under an expanded 33.45% rule when financed through FHA. All right. So what this means is that these rules change. All right. There's some, and we're really looking at DTI, which means debt to income ratio. So some different banks and different mortgage companies will have different ratios. And then sometimes the FHA ratio changes also. All right. But I'm just giving you guys a foundation on if you really want to see, okay, how much home can I afford? You can apply these rules and get a ballpark of what you can afford. But it's always better to just contact a lender and try to get pre-approved. So here, I'm going to show you an example of the 28 slash 36% rules as it varies by different income. And remember, the 38 rule is take your monthly gross income and you times it by 0.28, or you times it by 0.36. And by that, it'll come out to how much you can afford in home to buy. So right here, if you make $40,000, okay, your monthly gross is $3,333. Now, if you take that and times it by 0.28, it's going to come out to $933. If you times it by 0.36, it's going to come out to $1,200. So what the lender is going to say is, okay, this person can afford, just take the 36 percent rule on $40,000 a year. They can afford $1,200 worth of home. Okay, so this is how you'll know. And what you can do is you can take this and you can download an app like Zillow Mortgage. Zillow has a great mortgage app. You can download it, and it has an affordability section in there where if you made, let's just say $80,000, if you made $80,000 and you times that by, let's do the 36% by 0.36, then that would say that you could afford $2,400 a month to allocate to housing. So you could take that 2,400, and what you could do is you could put it in that calculator, and it's going to tell you how much house you can afford. Okay, keep it moving here. All right, so there are other affect your affordability, and they include income, debt, credit score, interest rate, down payment, and savings. So what we just talked about was one part. All right, we just talked about one part. Now, which affect the affordability, meaning how much home can you afford? We just talked about one part. Here are the other things that affect your affordability, or how much home you can afford. Okay. Other than improving your credit score for a better rate, which lowers your payment, there are three main ways to increase how much home you can afford. So, what are those three ways? Now, these again, the credit score is going to be the biggest factor in lowering your payment. Okay, but what other ways could you lower your payment? By earning more. If you earn more, of course, naturally, there's more home that you can afford. Also, pay down your debt. If you have a bunch of debt, if you have your debt to income ratio, what they do, what lenders do, is they put how much debt you have, and they divide that by how much income you have, and it comes up with a ratio. And according to that ratio is how much money they say that you're allowed to borrow for this home. But if you pay down some of that debt, that's going to allocate more of that income to be able to be applied to your home. So by paying down debt also helps your credit score. And also a larger down payment. Of course, naturally, the more that you put down, the lower the loan is going to be. So the more money that you could put down in a down payment, the smaller the loan is going to be. And if that's the case, then you'll be able to borrow more. And the reason is because you're putting down more, if that makes sense. So, so now that how much of the mortgage payment you can afford, you probably want to know how much home you can actually buy with that payment. Well, while you can't determine that 100% without knowing your interest rate, you can calculate a rough estimate. And that's what we're going to do in this module. Okay. So, assuming an average is 6%, and the thing about it is interest rates change. Interest rates change. So, interest rates actually change every day. Every day, interest rates change. So again, assuming an average of 6% interest on a 30-year fixed rate mortgage, your mortgage payment will be around $650 for every $100,000 borrowed. Okay, so here's a quick calculation. Here's right here. Okay, so you take your monthly payment using a 28% rule. You divide that by 650 times $100, $100,000, and that's your maximum mortgage amount. So solid start, but hang right. We'll tap more into how much home you can afford on the next track. The next track is going to be the renter's smart track, where we dive into creating your budget and your home buying savings plan. Okay. So now we're going to go into understanding the cost of buying. All right. Next, we're going to go into understanding the cost of buying. So to avoid being blindsided, it's a good to review the upfront cost of a home. The purchase price that your agent negotiates on your behalf when you're buying a home is the starting point, not the final number. Some people immediately think of the down payment, but buying a home also requires a home inspection, closing costs, and moving costs. All right. So when people talk about closing costs, a lot of times they just focus on the down payment. Well, what's my down payment? What is my down payment going to be? Okay. There are other costs than your down payment. There's soft costs like the home inspection and the appraisal. Home inspection is usually around 600, 700 bucks, and your appraisal is around 600 or 700 bucks. So that's soft cost that's not in the down payment and not in the closing costs. You also have moving expenses. So let's check out these four costs of buying to factor in what we need to save, because you're not getting home for free. Okay. People have courses and it's clickbait where they say, oh, buy a home for free. You're not getting a home for free. Now, I've gotten people money back at the table, but they need to have a certain amount of reserves, because the government doesn't want you to move into a house and then be house poor. And then something happens and then you go into foreclosure. The government definitely doesn't want that. Okay. Uh, this thing is killing me right here. Okay, let's get back into it. All right, so let's talk about four costs of buying a. All right, first you have your down payment. Your down payment is going to be 0.5% to 10%, and it could be as high as 20%. If you get an FHA loan, most of the time you're going to get a 3.5%. That's what down payment. That's why people love FHA loans. Now, as a loan, it's a more expensive loan than let's see, it's more expensive than a conventional loan. All right, but it's a low down payment. So with the FHA loan, it's going to be most of the time 3.5%. But down payments in general, you could pay 3.5 up to 10%. And again, if you're buying an investment property, shoot, it's 15 or 20%. All right. Next is closing costs. In closing costs, what you have is you have like transfer tax. For example, in Philadelphia, our transfer tax is high. Our transfer tax is like 2.5 something, 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 something. Well, actually, it's for something, but it's divided most of the time between the buyer and the seller. So you have transfer taxes. You also, if you're buying a home, you got title insurance, and there's some fees with that. So I tell people, okay, and this is just me, is when you're looking at a home and you want to know what's the down payment and the closing cost going to be, like all of this kind of wrapped in one, I usually tell people it's around 10%. Now it's not going to be 10%. It's going to be a little bit lower than 10%, maybe 7 or 8%, now 9% on the higher end. But I tell people that because that's an easy number to remember. Number one, it's a fast number to calculate. And number three is that if you have 10%, then you're going to have most of the time, not all of the time, but most of the time, you're going to have more than enough to buy the home. Okay. But in general, closing cost is going to be 2 to 5%. And again, it depends on where you're at. Inspection is saying 200 to 600. I'll take that. In Philadelphia, there's 3 inspections that we get. you get the home inspection, you get the radon inspection, and you get the termite inspection. But in Delaware County, you may have to get the sewer inspection. Okay. And then you have moving costs. Of course, everybody hates moving, or most people hate moving because of the effort that needs to be put into packing and then unpacking, but also renting the van, getting the boxes. On average, it's about 1,000 to $2,300. Okay. All right. So the next example uses $250,000 purchase price to illustrate how your down payment impacts the amount of money you will need to borrow from a lender to purchase your home. Okay, so notice there's a trade-off. The more cash you can afford to put down, the lower your total loan amount becomes, which ultimately means a lower monthly payment. So let's out. Okay, if you want to get an FHA loan in general, if you wanted to get an FHA loan and you were looking to put only 3.5% down, okay? So if you were only looking to put 3.5% down, your down payment will be $8,750, okay? Which is awesome. So your total loan is going to be 241,250, all right? So if you have a loan that's $250,000 and you put 3.5% down, your loan amount is going to be a little over $240,000. I'm just using round numbers because for you who can't see this screen, I want to use round numbers for you. Okay. So if you're putting down 3.5% on a loan that's $250,000, your total amount, if we're just taking your down payment away, is going to be a little over $240,000. Now, if you were to put 20% down, it would be $50,000. So then your total loan would be $200,000. Now this is money that you're going to have to borrow and pay over 30 years if we're looking at a 30-year fix. So the more you put down, the lower the loan amount is going to be. These costs up front, so you know how much to account for them in your home ownership plan. Don't let the cost of buying deter you from reaping the rewards and benefits of home ownership. Because some people might look at this and be like, oh man, that's a lot of money. I don't know if I have that money. And that's a lot of money to be putting down, or that's a lot of money to be paying at one time. Don't let that discourage you, okay? You should be prepared for the fees, taxes, and charges and various um, expenditures that you're going to have to cover. Okay. So note there are down payment assistance programs, and I specialize in down payment assistance programs. So if you're looking for a down payment assistance programs, make sure you contact me. If you see below here, that's my website, www.meetkhalid.com. So go there, set up an appointment with me, or call me. Like again, I specialize in down payment assistance programs. So we'll talk, and I'll definitely find the right assistance for you, because the government wants you to buy a home. The government wants you to buy a home, and they want to help you because they know homeowners pay what? Property taxes. All right. So let's move on here, y'all. So this is to understand the cost of home ownership. And this is one of the reasons why you have to have some type of reserves, because the government doesn't want you to buy this home um when you're using these different grants and down payment assistance programs. The government wants to give you the money, but they want to make sure that you have some reserves, so if something goes bad, they're in this with you. When you get a down payment assistance program to help you move into a home, the government is actually partnering with you. And so you're part of their investment. So they want to make sure that you have some type of reserve so that you don't just jump into the house, the pipe busts, and now you can't fix the home. Okay? Owning a home is a big responsibility. It's a responsibility. And although the financial benefits of home ownership are long term, there are costs associated with home ownership, unlike renting, such as maintenance, repair costs, home owners insurance, property taxes, and in some cases you have HOA fees. Some That's in condos, but you'll also have some culture sacks in some areas that have HOA fees also. So the maintenance and upkeep on your home um can include inexpensive repairs like fixing a broken toilet to some more costly repairs like a roof. Okay, so it's best to consider all costs of home ownership and be prepared for the mishaps and unexpected expenses. So you got them on both ends. You have a lot of benefit to owning a home, but like most things, there's a cost. Okay, there's definitely a cost. Like most places, it's not just all fun and games. It's definitely not all fun and games. Okay, but in my opinion, the good far outweighs the bad. Okay, so here are some of the here are most of the different costs of ownership. Okay, you have homeowners insurance. Got homeowners insurance, you got property taxes, you got HOA fees if you're in a condo or in an area that has a HOA. You also got roof repair. You also got lawn care. You got plumbing repair. You got utilities. You got general repairs and upkeep. You got weather damage. You have foundation repair. So it just all depends on the actual. Do this one real fast. All right, there we go. It all just depends on the home. All right. But if you stay in a home long enough, it's going to need repairs because things are going to happen. Things, well, things are definitely going to happen while you're living in the home. So it's not going to be all fun and games. It's not just going to be free. Okay. So let's understand. Let me do this real fast. Let's understand the role of credit in home buying. All right. Take a sip of my energy drink right here. But let's understand. So credit score is 300. I've mentioned before, but credit scores generally range from 300 to 850. 850 is the highest. Okay, your credit score will impact how much you can borrow and at what terms. A higher score increases the lender's confidence that you will make your payments on time and may help you qualify for lower mortgage rates and fees, which means a lower monthly payment for you. On the other hand, with a credit score of 620, your interest rates may be higher, and a credit score under 620 could make it harder to get a loan, although it's possible. So your credit score, I always tell people your credit score is going to get you in the door. And what is your credit score? Your credit score is a snapshot or a score of how you handle credit. So if we break this down to the lowest common denominator, the bank is going to loan you money. They're in the business of loaning you money. So, okay, I'm going to loan this person money, but how do I know that this person is going to pay me back? Well, credit score is a good indication of that. So people all the time ask me, well, what type of credit score do I need? And I always tell them a 620 or better. Now you can get a loan at a 580, but your interest rate is going to be high and your down payment may be high. Okay, but for a FHA loan to get a 3.5% down payment, it needs to be 620 or better. Now, here's the thing is that some people think, well, you know what? Let me wait until my credit score gets better. Yes and no. Here's the thing is that if you wait for your credit score to go up, yes, that could impact your payment to be lower. But then what if at the same time the interest rates go up? I had people back when when the interest rates were at 3.5, 4, and maybe they had a 620. And I'm like, listen, you need to buy a home now. Well, there's no. I'm gonna wait. I'm gonna work on my credit and get it to 700, or I'm gonna work on my credit and get it to 750. Well, they worked on their credit, got it up, but now interest rates are at 6%, and they may be at 7% now. So now you have that 700, but now interest rates are at 6% or 7%. But when I was telling you to buy, when you had a 620, interest rate was at 3% or 2%. So you can wait, but sometimes you shoot yourself in the foot. So what that person is really doing is they're speculating. They're speculating. And they're saying, okay, interest rates are going to be like this when it's my turn. Okay? Doesn't Most of the time it doesn't work out like that. So my advice is that if you have a 620, what you should do is get pre-approved, and based on that pre-approval, see how much that monthly cost is. And if that monthly cost is comfortable for you, pick which areas you want to live in and see if you can buy a home for that monthly cost. That's my suggestion. Okay. So now I'm saying all that, but a high score is better. So a high credit score can save you thousands. It definitely can. And if we're looking at this example right here, if you take a $200,000 loan and you take a 30-year fix, okay? If your score in general is between a 620 and a 639, if your APR or if your mortgage rate was 5.9, and let's just say your versus a person whose credit score is high, 760 to an 850, and their interest rate is 4.3. So you have the interest rate, two interest rates, good credit and bad credit, or low credit. Let's say low credit, okay? Qualifying but low credit. If you have somebody that has low credit versus somebody that has high credit, okay? What's the savings? The savings, I mean, over 30 years, it's going to be $67,000 in this example. $67,000. Now, people that have low credit, when they come to me, yeah, I'll tell them, hey, I have somebody that you should look into for credit help. And when they look into their credit help, they're like, oh, well, that person is expensive. Yes, they are expensive. So they may cost you a couple $100 or even $1,000. But if somebody is going to save you $67,000, is it not worth it? It's definitely worth it. Okay. So there is a savings from you having a good credit score. So if you are renting now, take this time to build your credit versus when it's time to buy. Okay. So, although credit standards have relaxed somewhat since the last financial crisis in 2008, there are minimum standards that you must meet to qualify for different mortgages. Good mortgage scores and an acceptable debt to income or DTI ratios are among some of the things that you'll need to qualify for a home. The requirements largely depend on the type of loan you're applying for. So, what are some of the things that you should need that you want to have when you're going into getting a home? You want to have good credit scores, and you also want to have a acceptable DTI, that's debt to income. Your income needs to be more than your debt, because again, the mortgage company or the bank wants to see, okay, is this person going to pay me back? Well, if you got a bunch of debt and your income is low, there's a good chance you probably won't pay them back. All right, so let's move on. All right. So here are some of the common non-qualifiers versus some of the qualifiers. Let's start on a positive note, the qualifiers, all right? So what are some things that you should have that check the box for the lender? Number one is a credit score higher than 620. So you have a credit score higher than 620, you're doing good. Also, consistent verifiable income for 2 years. Now here's the thing, there are lenders out there, if you got spotty work history, or you were out of work, there are lenders that will give you loans. The thing about it, the interest rate is just going to be a little bit higher. Okay. on a job for at least a year. And these aren't hard and fast. This is in general. All right. Also, bank account in good standing. Here's the thing. When you have the money in the bank, do not flip flop the money, meaning that you're taking the money out and then put it back in, and taking it out and put it in back in. You want to make sure that your bank account has money in it for 2 months. If you put a large amount of money in the bank, the lender is going to want to know, where's this money coming from. Okay. So you just want to make sure. I'm not saying don't touch the bank account, but they're just looking for large deposits in and out. As long as you can go back 2 months, they're not going to ask you any questions as far as that money. But if they see a large deposit of $10,000 that you just made um, last week or 2 weeks ago, they're going to ask you about it. Okay. And also, they don't want to see no overdue debts and judgments. Now, again, if you don't have these aren't deal breakers. Okay. There are people that can do these things, but in general, these are people who check these boxes. They may find it easier to get a loan. Now, what about common non-qualifiers? Common non-qualifiers are if your credit is less than 580. Okay. If you've been on a job less than a year, if you don't have a bank account, if you have overdue judgments and debts on your credit, and also if you have non-sufficient funds, bank activities in the last 6 months. So again, if you have these, they aren't deal breakers. It's just going to be a little tougher in order for you to get a mortgage, but there are people out there that will. So now let's understand. So we talked about, and I kind of beat you up in reference to getting qualified for a home. Now, what are some of the benefits of home ownership? Okay. What are some of the benefits of home ownership? Let's take a look. So, number one is more stability. All right. In addition to never have to worrying about a lease expiring and needing to renew or your rent increasing each year, you can predict this home expense because it's a 30-year loan. It's a 30-year loan. So you don't have to worry, man, this next go around, are they going to try to kick me out? Or this next go around, are they going to try to increase my rent? No, you'll know going 30 years what your mortgage is going to be. So that's number one. You'll be more stable. Number two is automatic savings. In many markets, owning can save you hundreds of dollars per month over market rents. In a lot of places like Philadelphia, there was just a study done where owning a home in Philadelphia is less expensive than renting. So you're automatically saving just by having a number three is incentives. In many cases, it's possible that your closing costs, mortgage loan interest, and property taxes on your personal income, your personal tax return, if you file an itemized return. All right. There's no tax break for renting. So with buying a home, again, the government gives tax breaks. The government gives tax breaks to what's the word I want to use? To influence behavior. The government gives tax benefits to influence behavior. And they want people to buy homes. So since they want people to buy homes, they give them tax breaks because they want to influence behavior. So with buying a home, there's some tax breaks. This is probably the biggest benefit is equity. Okay. Homes typically increase in value. That means you have the opportunity to build wealth over time. I just did, if you go on my YouTube, the at real estate board, if you go to my YouTube, I just talked about this, how one of the ways, one of the reasons why African Americans are behind in economics or financially is because we don't own homes. And when we don't own homes, we're missing out on the building of equity because a home is one of the only investments where you purchase a piece of it or you pay a part of it, but you have control over the whole investment. So to buy a home, that's $100,000, you only got to come up with roughly $10,000. Now, if that home goes up in price to $200,000, now that's $100,000 of equity that you have, but you only paid what, $10,000. So from redlining, from keeping blacks out in different areas, going back generation after generation after generation after generation, blacks have missed out on this economic boom, on this investment on steroids, basically. So that's why it's important for us to own homes. Because if anybody is thinking about generational wealth, what's generational wealth? Me having wealth and passing that wealth on to my heirs, my children, so they don't have to start at the same storyline that I started out. Somebody will have to rumble me to convince me that the foundation is not properties or real estate. The foundation of generational wealth is real estate. So if you don't own a home, I really don't see how you can even speak about generational wealth. Now, I'm not saying that you have to live in a home. Maybe you own a home and you rent. But if you don't own real estate, I don't see how you can even talk about generational wealth. If you ask me, that real estate is the foundation of generational wealth. The foundation. Okay? So, wrapping this up here soon, also, some of the benefits is greater privacy. A detached home has more privacy and is quiet than living in an apartment or a townhouse. Now, Philadelphia is probably, we're the capital of probably townhomes, okay, or row homes. All right. So, also the last benefit we're going to talk about is freedom. You got the freedom to do whatever you want in your home. You can paint the walls. You can knock them down if you want to. You can make modifications. You don't have to ask the landlord to, can you move this sign, or can you put recessed lights? You could do whatever you want in your home. All right. So home is a big deal. Okay. So you're going to be doing it for the first time, or you're going to be giving it a second go. Okay. So you may not be ready to buy your first home today, but when you prepare for home ownership with us, with me, you'll navigate the process with confidence. All right. So the next track is going to be the renter smart track. All right. And these are actions that you can take while renting that will put you in a better position to buy when your lease is up. Okay. All right, y'all. This is Colin Nathan Aleem, the real estate boy. Listen, it doesn't matter where you're getting this. If you are renting or you just don't own right now and you do want to own a home, definitely contact me and I will put you in the right place as far as to buy a home. You want to contact me, my phone number is 267-930-1249, or you can always go to www.meetkhalid.com. You can book a virtual appointment with me, or you can give me a call. Please follow me on all social medias. All right, guys.